The iron ore market proved to be very resilient amid the pandemic outbreak last year. The price of 62% ferrous content iron ore had a very good run in 2020. We witnessed it reaching 6-year high in September of last year, and it continued to climb high into this year as well, to reach a new peak of 9-year high until very recently the price has retreated from the highs due to environmental curbs in Tanshan. So there are multiple reasons why the market stayed upbeat despite COVID. Firstly, weather conditions led to some supply tightness, particularly in the beginning of last year. Secondly, there were supply disruptions related to COVID, so some mine closures, some labor shortages at mines, and some delays at major iron ore ports. But the main reason why iron ore performed so well was an incredible resilience of downstream demand in China. A combination of China's quickly handling the pandemic, enormous fiscal stimulus and investment in infrastructure, Bank of China's accommodative interest rate, all meant that blast furnaces kept burning raw material, unlike, for example, in Europe, where large capacities were cut and blast furnaces idled. This, of course, had effect on global seaborne iron ore trade, and our Refinitiv trade flows, the model that tracks iron ore carrying vessels, indicated that iron ore exports were down in the first quarter of last year. But from Q2 onwards, when China's economic activity returned, global seaborne trade completely recovered. We also noticed some interesting trends. Not surprisingly, China grew its share of global iron ore imports last year from 69% in 2019 to 73% in 2020. In fact, looking at 3-year history, which is also available for Refinitiv trade flows, we can see that pandemic just accelerated the trend, where Japan's and South Korean shares kept decreasing while China's share kept growing. Although political tensions between Australia and China restricted Australian coking coal import, the situation with iron ore was completely different, mainly because at the moment there is no viable alternative to Australian iron ore. So overall, the share of Australian global export gained 2.2% last year compared to 2019, while Brazil's share dropped 0.7% during the same period, and South Africa's share remained largely unchanged. Interestingly, shipments from India almost doubled year-on-year last year, as India's lower grade material served as a feed for blast furnaces keep going and running over the period of lockdown at the beginning of last year in China. Similar situation with Chilean exports. The trend clearly demonstrates the impact of COVID-19 had on iron ore demand in China versus the rest of the world. The largest exporter as well as a producer last year was Rio Tinto, having shipped 25% share of global seaborne iron ore. Vale was the second largest producer and exporter in 2020 with 22% share of global flows. Now, looking ahead into this year and a little bit into the next year, we developed a model which is based on machine learning algorithms that predict iron ore demand in China for the next 8 quarters. We used a number of steel demand variables in our modeling as a proxy indicator for iron ore demand. These indicators represent different sectors such as auto, machinery, construction, energy, and shipbuilding as the largest sectors where high volumes of steel are required. According to our model, China's iron ore demand is set to rise by 19% year-on-year in 2021 to 1.7 billion tons. The model's results broadly reflects most analysts' expectations for this year. China's GDP grew 6.5% in Q4 of 2020, which was 0.5% higher compared to Q4 2019. The country's prospects of economic growth remain strong, with 8% GDP growth for this year, as IMF expects. So this year, most of growth drivers from last year remain very much in play. However, it is important to note that although historically the model has proven successful, as with any other statistical model based on machine learning algorithms, there are multiple elements that it doesn't consider. For example, the recently announced 5-year plan that calls to cut steel capacities in order to reduce the country's CO2 emissions by 65% over the next 10 years compared to 2005. So although our proprietary model expects China's iron ore demand to grow strongly in 2021, undoubtedly there will be more headwinds in the form of reaffirmed government measures to reduce steel capacity. Therefore, the model's predictions should only be used as to assess overall demand trends. Thank you.